If you ever wondered if saving for retirement now can help lower your taxes, the answer is yes. And it helps a lot more than what most people realize. Welcome back to the channel. I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audit, and taxes. And I'm all about helping you take control of your money by living smarter. Be sure to subscribe to the YouTube channel and turn on all notifications. And check out our blog site where we post every Monday, Wednesday, and Friday. In today's video, I'm going to break down the tax benefits of retirement contributions, explain how accounts like 401ks, IRAs, and Roth accounts work from a tax perspective, and show how your retirement planning can be one of the smartest legal ways to reduce your tax bill. If you want to save money on taxes and build wealth at the same time, this is for you. A lot of people think that retirement savings is only about the future. And yes, that is a huge part of it. But what many taxpayers miss is this: retirement contributions can also help you financially today by lowering your taxes. That means every time you contribute strategically, you may be doing two things at once: building long term wealth, improving your current tax situation. And honestly, that's one of the best combinations in personal finances. Let's start with one of the most common retirement accounts, the traditional 401k. When you contribute to a traditional 401k, that money usually goes in before federal income taxes are applied. So let's say you earn $80,000 per year. If you contribute $10,000 into your traditional 401k, your taxable income may drop to around $70,000 for federal income tax purposes, depending on your situation. That matters because the IRS taxes you based on taxable income, not just what you earned gross. So, contributions can help lower your taxable income, reduce your tax bill, and potentially keep more money in your pocket. For 2026, the IRS allows many workers to contribute up to $24,500 into a 401k, with extra catch up contributions for people age 50 and older. That's pretty serious tax planning opportunity. Now, here's where it gets interesting. Sometimes retirement contributions can help you from creeping into a higher tax bracket. But a quick reminder: a tax bracket doesn't mean that all your income is taxed at one single tax rate. But reducing your taxable income could mean a lot. It can potentially help with things such as tax liability, being able to take certain tax credits and deductions, and even other financial planning matters. So, retirement contributions don't just help you for later, but they can also help with the structure of your tax return today, and that's a big deal. Now, let's talk about traditional IRAs. A traditional IRA can also give you a tax deduction, but there's a catch. Not everyone gets the full deduction. Whether you can deduct your contribution depends on things like your income, your filing status, and whether you or your spouse are covered by a retirement plan at work. If you qualify, your traditional IRA contributions may reduce your taxable income just like a 401k contribution can. For 2026, the total IRA contribution limit is $7,500, with the higher limit for those age 50 and older. So if you're not maxing out your workplace retirement account, or if you don't have one at all, a traditional IRA may be a very useful tax move. Now, let's flip to the other side of the coin and talk about Roth accounts. This is where people get confused. A Roth IRA or a Roth 401k generally does not lower your taxes today. Why? Because Roth contributions are made with after tax dollars. That means you pay taxes on that money now. So why would anyone do that? Because the benefits come later. If used correctly, qualified withdrawals in retirement can be tax free. That means no federal tax on the growth, no federal taxes on the withdrawal if the rules are met, and potentially much more flexibility in retirement. So while traditional accounts may help you now, Roth accounts can provide a powerful long-term tax strategy. This is why tax planning isn't just about this year, it's also about future years. So here's the daunting question: which is better to take, the traditional or the Roth? And the answer is honestly, it really depends. Traditional is best if you want to take the tax break today, you're in a higher tax bracket, or if you want to reduce your taxable income. And the Roth may be better suited for those that think that their income is going to be higher in the future, they believe that tax rates will be higher in the future, or for those that want a tax free retirement living. It's best to work with your financial advisor or financial planner who is certified in these areas. Now, let's move on to talk about one of the best kept secrets. A lot of people have never heard of this. It's called the Saver's Credit. The Saver's Credit is designated to reward eligible low and moderate income taxpayers for contributions to retirement. And here's the key difference: a deduction lowers taxable income, a credit lowers your actual tax bill directly. That makes a credit especially powerful. Depending on your income, filing status, and contribution amount, you may qualify for a credit equal to 10, 20, or 50% of your qualifying retirement contribution. The maximum credit can be $1,000 for single filers or $2,000 for married filing joint if eligible. So, if you qualify for retirement contributions, this might help you with a deduction, a credit, and a long term savings. That's a triple win. If you're self employed or a business owner, retirement contributions can be an even more powerful tool. And here's why: because you may have access to retirement plans that allow for larger contributions and stronger tax planning opportunities. Some common options include a SEP IRA, a SIMPLE IRA, and a solo 401k. These can help business owners to reduce taxable business income, build personal retirement wealth, and create a better year end tax planning strategy. This is one of the reasons I always tell small business owners retirement planning is not separate from tax planning, it's tax planning. And if you wait until tax season to think about it, you may miss opportunities. Now, let's talk about mistakes, because the IRS absolutely does not hand out golden stars for good intentions. Here's a few common issues. One, contributing too much. If you exceed contribution limits, you may face penalties. Number two, assuming all accounts are deductible. Not all retirement account contributions lower your taxes today. Number three, using the wrong account for your income level. For example, traditional versus Roth should be a part of a bigger tax strategy, not just a random guess. Number four, ignoring deadlines. Some retirement contributions have a specific tax year deadlines. Number five, not coordinating retirement with the rest of your tax return. This is where people leave money on the table. For example, a retirement contribution might impact your adjusted gross income, tax credits, tax deductions, and long term planning. So it's bigger than just putting money away and hoping for the best. So here's the big picture: retirement contributions can help you to lower your taxable income, potentially reduce your tax bill, qualify for valuable tax breaks, and build long term financial security. That's why this is one of the smartest financial moves available when it's done intentionally. If you've been treating retirement contributions like something I'll get to later, it may be time to reframe that. Because this isn't just about retirement, it's about making your money work smarter right now. If this video helped you out, hit the like button and be sure to subscribe and turn on all notifications for more tax tips from a licensed CPA. And be sure to share this with someone who may need to hear this. And remember, those retirement contributions don't just help with the future, but they can also help with reducing your tax bill legally today. And I'll see you guys next week, same place, same time.